we are covering interest rates and yield curves for the Series 65 exam. The most fundamental concept to master is the inverse relationship between interest rates and bond prices. A helpful way to remember this is to think of a seesaw. When interest rates go up, the prices of existing fixed-rate bonds go down. Conversely, when interest rates fall, existing bond prices rise. The exam will test this from every angle. For example, if an investor holds a 5-year bond with a 3% coupon and newly issued bonds of similar quality are now offering 5%, the investor's 3% bond is less attractive. To sell it on the secondary market, its price must be lowered to offer a competitive yield to a new buyer. The exam will expect you to know that bonds with longer maturities and lower coupons are the most sensitive to these interest rate changes. This relationship between time and interest rates is visualized by the yield curve, which plots the yields of similar quality bonds, typically U.S. Treasuries, across different maturities. The exam requires you to know 3 primary shapes. A normal yield curve is upward sloping, meaning long-term bonds have higher yields than short-term bonds. This is the most common shape and signals that the market expects healthy economic expansion. An inverted yield curve is the opposite. It's downward sloping, with short-term bonds yielding more than long-term bonds. This is a rare but critical signal the exam will test, as it has historically been a reliable predictor of an upcoming economic recession. Finally, a flat yield curve, where there's little difference between short and long-term yields, suggests a period of economic uncertainty or transition. The exam will also test your knowledge of key benchmark interest rates, specifically the federal funds rate and the prime rate. The federal funds rate is the interest rate that banks charge each other for overnight loans to meet reserve requirements. It is the most volatile interest rate and is the primary tool the Federal Reserve's Open Market Committee uses to implement monetary policy. A common exam trap is to confuse this with the rate the Fed directly sets. The Fed sets a target for the Fed funds rate, which it influences through its operations. The prime rate, on the other hand, is the rate that commercial banks charge their most creditworthy corporate borrowers. It is not set by the Fed, but it is directly influenced by the Fed funds rate, typically staying about 3% higher. For the exam, remember the pecking order. The Fed targets the federal funds rate, which then directly influences the prime rate and other consumer and business lending rates throughout the economy. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.